Another huge deficit. The federal government just released a budget that plans a $78 billion shortfall next year. That's a lot of red ink. And people are asking, what does that mean for my taxes, my job, my mortgage, and my future? Today, I'll explain the budget in plain English, why the deficit is this big, what you should do with your money right now. I'm Thuc, your money guy. Let's get into it. So what did the government announce? The 2025 federal budget projects a deficit of roughly $78 billion for the next fiscal year. That is about 2.5% GDP under the government's numbers. The plan also includes a multi-year program of big capital spending, roughly $280 billion over 5 years, and some cuts to government operating costs. The government says much of the new spending is for infrastructure, defense, and incentive to boost private investment. Translation, the federal government is choosing to spend a lot now on big projects, and to pay for that, it will borrow more this year. That $78 billion number sounds scary, but context matters. Is this temporary stimulus or a long-term problem? Let's unpack the why. So why is the deficit this big? There are three main reasons the deficit jumps so much. First, new capital projects. The budget front-loads spending on big infrastructure, energy, ports, transit, defense, which is expensive upfront but designed to raise future growth. That's the $280 billion over 5 years the government announced. Second, a weaker economic outlook than expected. The government assumes slow growth over the next year or two, which reduces tax revenue and raises the deficit compared with earlier projections. Analysts point to global trade tensions and weaker demand as part of this reason. Third, policy choices. The government chose to spend more now rather than cut more deeply. That includes tax credits, incentives for business investment, and defense spending increases. Combine these choices, raise the borrowing need. Reviews from policy groups and accounting firms show much of the increase is deliberate and linked to the capital program. So big spending plus slightly weaker growth plus political choices equals $78 billion. Okay, so the government is borrowing, but how big is this debt compared to what Canada can handle? That's the next important question. The budget team stressed that Canada's public debt level is still low compared with many G7 countries. Under the government's plan, net debt to GDP rises but remains below peer averages for now. They also introduced a new accounting framework that separates capital spending from operating spending. The idea is to show that big investments shouldn't be treated the same as day-to-day running costs. What does that mean for you? The government wants people to see this as an investment-led budget. Borrow now for projects that should help grow later. But watch the numbers. Debt service, the interest you pay on debt, is expected to rise slightly as the interest rates stay above the decade lows we had earlier. That means the government will spend more on interest payments even if they don't borrow more. Analysts flag that debt servicing as a share of revenue will increase over the years if conditions don't improve. Debt is manageable today, but the cost of that debt matters. Let's talk risks and benefits for everyday people. So who benefits from the budget? First, workers in construction and infrastructure. Big capital plans mean jobs, roads, ports, energy projects all need people. That helps regions with shovel-ready projects. Many analysts and the budget itself highlight that building infrastructure creates near-term jobs and long-term productivity. Second, businesses that get tax incentive. The budget includes new tax allowances to spur private investment, designed to make Canada more attractive for capital spending. If those incentives work, companies that invest in equipment or factories could gain. Third, defense and strategic sectors. The budget raises defense and industrial spending, which benefits suppliers and certain regions where defense work is concentrated. In short, people and firms connected to infrastructure, construction, industrial supply chains, and some tax-sensitive businesses will benefit from the extra spending. Sounds good for some, but what are the downsides? Who could lose from a bigger deficit? So there are several risks to watch. Higher interest costs. If interest rates remain higher than the past decade, the government and household borrowers will pay more interest. For households, that means mortgages and debt are more expensive. For the government, higher interest budgets crowd out the other spending. Deloitte and other analysts warn that debt service costs will rise as a share of revenues. Future tax pressure. Bigger deficits today could mean higher taxes later, either to pay interest or to reduce debt. The government said it'll balance operating accounts over time, but if growth disappoints, pressure on future budgets increases. Conference Board and RBC commentary note that fiscal choices today shape future room to maneuver. Inflation and monetary policy interplay. The Bank of Canada's decisions on interest rates depend in part if fiscal policy is stimulated while supply constraints remain. The central bank might keep rates higher to control inflation, which feeds back into mortgage and loan costs for households. Execution risk. Large capital programs are hard to deliver. Delays, cost overruns, and weak private sector response could make the spending less effective than hoped. Several independent analysts caution that simply announcing capital spending doesn't guarantee results without strong project delivery. People need to understand. Households sensitive to interest rates, taxpayers in the future if taxes rise, and anyone hurt by weak execution or inflation surprises. Okay, so what should a regular person do with money while the government borrows more? Here are clear, simple steps I recommend for everyday people. Check your emergency fund. If the budget means higher interest or more volatility, having a 3 to 6 months of expenses gives you breathing room. Manage high-cost debt. If rates might stay higher, paying down credit cards and expensive loans is effectively a guaranteed return. Fix or shop mortgage rates carefully. If you have a mortgage renewal coming, compare offers and consider locking a rate if it fits your plan. But don't panic buy a longer term just because of headlines. Balance flexibility and cost. Think long-term for investments. Big deficits don't change the long-term case for diversified investing in stocks, bonds, and real assets. However, you may want to check your allocation. If you're very rate sensitive, having a cushion or more diversified helps. Watch tax and program changes. If the government moves to raise revenue later, prepare for potential adjustments. Tax planning doesn't mean dodge taxes. It means be efficient where you can be. RRSP, TFSAs, where appropriate in Canada. Follow local opportunities. If you work in construction, engineering, or trade industry, there will likely be jobs from infrastructure spending. If you are a small business owner, see if new incentives or procurement rules apply. These are practical, low-risk steps you can take now to protect your finances in a higher deficit, higher investment environment. People ask, so is this debt reckless? The truth is somewhere between risk and strategy. Let me explain the debate. Investment versus recklessness. So, number one, the first side said, borrow to invest. Big infrastructure can boost productivity, create jobs, and raise long-term growth. If the projects succeed and private investment follows, future revenues can pay down today's debt. Conference Board and others frame the budget as an investment-led strategy. On the other side, risk of fiscal drift. If projects don't deliver or growth lags, deficits add up, interest costs rise, and the country faces higher taxes or cuts later. Skeptics point to execution risk and the possibility that political promises won't produce measured returns. Analysts from major banks and policy shops caution the plan needs strong follow-through. So here's my take on this. Both sides have valid points. The plan can work, but it requires careful delivery, private sector follow-through, and watchful central banking. That's why citizens and markets will watch the next few budgets closely. The final takeaway in plain language. $78 billion is a big number, but it's not automatic disaster. It's a policy choice. Spend now to try to boost growth later. That choice comes with risk, higher interest costs, potential future taxes, and the need for good execution. For most people, prepare. Save, reduce expensive debt, check mortgage plans, but don't panic. Use this moment to get financially stronger and to look for real opportunities, jobs, contracts, or investment chances created by the spending. If you found this useful, hit like, subscribe, and share this with people you know. Stay tuned to my weekly videos. I'm Thuc, your money guy, making money simple, smart, and stress-free. See you next time.